Welcome to the ProTicker Deep Dive. Okay, so let's dive right in. We're talking about something massive today, aren't we? The financial story of the decade,
I think you could definitely call it that. Yeah, a complete re-architecting.
of how money moves globally. It's not just like a minor update, is it?
No, no, not at all. Think total replacement of the plumbing, so to speak.
Right. So can you even picture it? A future where your bank is, well, just your phone.
Mm-hmm.
Your paycheck hits your account instantly.
Yeah.
And sending, I don't know, a huge cross-border payment, $100 million.
Takes seconds, not days like it used to.
Exactly. Seconds. Sounds kind of futuristic.
But it's happening right now. That's the thing. We are living this. The foundations of finance are being rebuilt as we speak.
Wow.
And for you, our listener, figuring out what's real and what's just, hype, that's crucial.
So that's our mission today, right?
Yeah.
Decode this. Focus on how money is actually moving now.
Precisely. We need to cut through the noise. So the quick summary is this. You've got this huge speed up in digital payments, generally. Then you have stablecoins taking off, central banks exploring their own digital currencies,
Right.
CBDCs, and massive institutional money finally jumping in. It's all blurring the lines, between old school banks, the flashy fintechs, and DeFi.
Decentralized finance.
Exactly. And what's really pouring fuel on the fire is regulatory breakthroughs, things like the EU's MiCA framework.
Which standardizes crypto assets.
Yeah, across the whole block. And in the U.S., you've got things like the Genius Act, which is aimed at sort of smoothing the path for stablecoins and payment innovation.
That clarity must be huge because it forces everyone, investors, banks, even governments, to stop and think, what is money now, if it can move that fast?
It changes the whole game. Absolutely. So let's look at that bigger picture first, the macro view. Digital payments. Well, they've hit a tipping point globally.
We've seen that coming for a while, right?
Yeah.
Especially in Asia and Europe.
Definitely. They've been way ahead on instant payment rails, fintech adoption for years. But the U.S., it's now transforming incredibly fast.
And that's driven by the regulation you mentioned?
Largely, yes. That regulatory clarity, especially around stablecoins, and of course the big one, the SEC approving Bitcoin ETFs, that opened the floodgates.
So are we saying goodbye to that awful feeling of, waiting for funds to clear, sending money and checking your account for 3 days?
Well, hopefully. That's rapidly becoming history. Global money movement is just getting so much faster. Real-time payments, open banking APIs, letting different apps talk to each other.
And digital wallets, they're just standard now, aren't they?
Pretty much default in most big economies,
Yeah.
yeah. But that speed raises interesting questions about sovereignty. Because while private companies are pushing stablecoins...
Like USDC, USDT.
Exactly. Central banks are reacting. You've got the World Bank, the IMF. They're really pushing this idea of central bank digital currencies, CBDCs.
Why though? What's the goal there?
Well, two main things, really. One is financial inclusion, getting banking services to people who don't have them. The other, and this is crucial, is maintaining control, monetary sovereignty.
Control against what? The crypto economy?
Kind of, yeah, against this fast-growing private crypto-native system. They want to make sure they still have the reins.
Okay, but hang on. If stablecoins already exist and they're efficient for instant digital dollars, why spend billions building government CBDCs? Isn't that just doing the same thing twice?
That's a great question, and it gets to the heart of it, trust and control. Stablecoins are issued by private companies. They're liabilities of those companies.
Right.
CBDCs would be direct liabilities of the central bank itself. So for a government, it's about ensuring they have a direct digital pipeline, for monetary policy, for stability if a private system fails. It's basically a battle for who owns the future payment rails.
Fascinating. And while that battle plays out, the private side isn't waiting, is it? Crypto's going mainstream.
Absolutely. Stablecoins aren't just for crypto traders anymore. You can use them with regular credit cards now. Check out online. They're becoming the go-to for international business payments, B2B stuff.
And Bitcoin. It's not just some weird internet money anymore.
Not at all. With the ETFs, it's become a serious institutional-grade asset. It's pulled in massive amounts of Wall Street money, which definitely changed its image. Less Wild West.
Okay, so I've got the concepts, the regulations.
Right.
But let's talk numbers. Because this isn't just talk, right? The data shows this shift is real.
Oh, the data is staggering. I mean, look at overall digital payments. Transaction volumes are set to hit over $12 trillion this year alone.
$12 trillion.
And it's still growing fast. We're talking a projected growth rate, CAGR, of like 15 to 19% every year through 2030. It's a fundamental change. But the truly explosive area, stablecoins. This is where you really see the demand for instant digital dollars. Monthly transaction volume blew past $1.3 trillion back in August.
A month. 1.3 trillion.
Per month.
Yeah.
And their total market cap, it shot up to $320 billion. That's 83% growth year over year. Doubled. Almost double in just 1 year.
Wow. Okay. And you mentioned DeFi earlier, decentralized finance. That's growing fast too, right?
It's on a serious upward curve, moving beyond just early adopters. Projections put the DeFi market at around $32.4 billion by the end of this year. But if it keeps compounding like it has been,
Yeah.
we could be looking at something like $390 billion by 2030. That's a 54.2% compound annual growth rate. That's just incredible growth. It's an ecosystem really building on itself.
And how are the big established players reacting to all this? The Visas, the MasterCards?
They're jumping in. They have to.
Yeah.
Visa, MasterCard, PayPal, they've all built stablecoin features into their networks.
Right.
Stripe, the big payments processor. They got back into crypto specifically to offer easy ways to buy and sell stablecoins, the on-ramps and off-ramps, bridging
Right.
the gap.
And people are actually using this stuff.
Seems like it. Look at Block, formerly Square. Their Bitcoin revenue in Q3 just hit $2 billion. That tells you consumers are definitely interested in using these digital assets.
So what does this mean for traditional banks? Are they losing out?
Well, their payment volumes are still growing, but
Yeah.
slower. They're definitely losing transaction market share to these newer digital-first players. The fintechs, the big tech companies with their own payment systems. It's a real challenge for the old guard.
Okay, so that leakage from banks leads us straight to Wall Street, doesn't it? The institutional money pouring in. That seems like the biggest game changer recently.
Arguably, yes. It brings stability, liquidity. It legitimizes the space. And nothing shows that more than those Bitcoin ETFs we mentioned.
Right, like BlackRock's IBITs. The
Okay.
numbers there are just mind-blowing.
Over $100 billion in assets under management in one fund, capturing, 61% of that institutional ETF market. It's unprecedented.
When you see a number like $100 billion flowing into one product based on a digital asset, is that more about Bitcoin itself finally proving its case? Or is it just that big money managers are desperate for growth anywhere they can find it?
It's probably a bit of both, but I lean towards the latter. It's a definitive signal that the big asset allocators, the smart money, now see crypto, or at least Bitcoin, as something they have to have exposure to, an asset class.
And that changes things.
Fundamentally, it brings in serious liquidity, and it probably helps dampen some of that crazy volatility we saw in the early days. And all this capital, it's fueling a massive competitive race, a fintech arms race, you could say.
Unicorns everywhere.
Hundreds of them, billion-dollar valuations. The global fintech unicorn club is probably near 500 by now, and a lot of them are focused squarely on payments, on blockchain solutions for businesses.
And it feels like everyone's trying to get into everyone else's business now.
Total convergence. Yeah, you've got crypto companies getting banking licenses, partnering with banks. You've got banks launching their own Web3 projects, card companies racing to partner with stablecoin issuers.
It's a scramble.
It really is fierce competition.
Just quickly, for people watching the markets, Bitcoin's price, it hit some highs earlier this year, right? Over 100K.
It did peak above $100,000 mid-year, but it seems to have found a solid base, consolidating around that, say, $90,000 to $100,000 level.
And that's supported by the ETF money flowing in.
The institutional flow provides a huge support level, absolutely. If you look at things like moving averages, the technicals, the markets may be cooled off a bit from the really explosive gains in 2024, but it's still looking pretty strong, still well bid.
Okay, so we've painted a pretty exciting picture. But, for anyone listening and trying to make sense of this, understanding the risks is just as important as the upside, right? We need balance.
Absolutely critical. You have to see both sides clearly. So on the bullish side, the opportunities. We've basically hit the main ones. First, that institutional adoption. You can't argue with $100 billion in IBIT. That's real.
Proof point.
Second, the regulatory clarity. Things like MiCA in Europe, the Genius Act in the US, they create standards, reduce uncertainty, and that attracts serious investment and talent.
Makes sense.
And third, the DeFi evolution. It's not just experiments anymore. These protocols are starting to handle serious stuff like institutional borrowing, sophisticated risk management, real financial plumbing.
Okay, so those are the big opportunities. But what about the red flags? The things to watch out for?
Right, the bearish points. First one is still volatility and cyber risk. Even with institutional money, these markets can still have sudden drops, flash crashes, weird algorithmic behavior.
So risk management is key.
Crucial. And cybersecurity. Breaches are maybe less common now, but a big hack could still be devastating for a platform. It's an ongoing threat. Second big risk, regulatory overhang. Yes, we have clarity in some places, like the EU, but if rules globally remain inconsistent, or if some countries crack down hard, that could really slow things down.
And create weird incentives, right?
Yeah,
Companies just going wherever the rules are weakest.
exactly. Regulatory arbitrage, it fractures the market, makes things less efficient, less safe overall.
Okay. And the last risk. You mentioned trust earlier.
Yes, the third one ties back to stablecoins and this whole integration push. Let's call it the risk of bifurcation of trust. Meaning not all these new digital dollars or platforms are built the same. As banks start offering tokenized deposits or using stablecoins, you, the customer, need to know, are the reserves backing this actually there? Is the company solvent? Is it compliant?
So the danger is that some are solid and some are just
Yeah.
smoke and mirrors.
Potentially. We need transparency and audits that are real, not just, claims on a website. It's the risk of repeating past financial mistakes, but in a new digital wrapper. Vigilance is key. Hashtag outro. So, wrapping this all up, the core message is clear. This disruption in finance. It's happening now. It's present tense. Digital payments, crypto. They're past the hype stage and becoming fundamental infrastructure.
Right.
And the next few years, well, they're going to reward the people and the companies who get the balance right. You need to understand the regulations, manage the risks carefully, but also be ready to jump on these technologies that really are changing the game.
It's a tightrope walk.
It really is. Speed and nuance.
So a final thought for everyone listening, something to tell on. It seems like through all these tech shifts, the fundamental currency, the thing that really matters, is still trust, isn't it?
Always. In any financial revolution.
So the takeaway seems clear. Keep learning, keep asking questions, and maybe don't blink, because this new money matrix is unfolding fast. See you all in the next Pro Ticker Deep Dive.